Hello options traders, good morning everyone. Well, this is, as promised, the second of a two-part series. The first one was our previous video called The Bend is Your Friend. So if you didn't see that first, you might want to go back and check that out. But the reason we had to talk about that bend in the risk graph is to have an understanding of what the option does and why we buy an option. But the next step, or the related question, is, well, why should we pay for time? So many times I hear traders say, well, if I buy time, I've got to spend more money, and that means there's potentially more that I could lose. And so it seems to be more of a defense mechanism, and they're saying, if I only put a little bit of money into it, then I can't lose as much. All right, well, that might be true, but it also means you've got a much, much lower chance of even making money. And so there's a lot of misperceptions that come with this whole idea of paying for time, and that's what we're going to take a look at in this video. And of course, before we get started, please be sure to click like and subscribe. I appreciate that very much from all of you who have done that. It is definitely making a very big difference in the promotion of this channel. So first off, more time. Understand that in the financial markets, time is risk. More time means there's more time for the stock price to fall, and it also means there's more time for it to rise. But it's this idea that it might fall that really puts fear into traders, and that's why they don't like to buy time. But more time means you have a better chance for success. And this is really where the heart of option strategies gets to, is to say, well, based on the risks that you're willing to take, let's construct a strategy that gives us a very good chance for profits, but also gets rid of any risks that you don't want. And there's a lot of ways we can do that. But for this video, I'm just going to talk about long options and to show you some of the misperceptions that people have with options pricing. Now, before we get into the Excel spreadsheet, quick refresher. We've talked about this before, but the square root pricing rule. And this is going to be important for understanding some of the relationships we're about to see. Remember that it takes about 4 times the amount of time to double an option's price. This applies to the at-the-money options only. And the reason for this is that option prices are proportional to volatility, and volatility is proportional to the square root of time. So an example that I often show is, let's imagine that we have a 1-month option trading for $1, and we're sitting here wondering how much a 4-month option should be worth. Well, most traders would say, well, it's got to be worth $4 because there's 4 times as much time. And that's absolutely incorrect. The way that we figure it out is we recognize that yes, there's 4 times the amount of time, but we have to take the square root of this multiplier, 4. So if we take the square root of 4, we get 2. And what this 2 is telling me is that the second option should be 2 times the value of the first. So because this first option is $1, we would expect to see this one trading for 2. If this first option were $3, this would be trading for about 6. But notice that it's going up by a factor of 2 in the price, not because there's twice as much time, but because there is the square of the factor, or 4. So if we take 2 squared, or 2 times 2, we get 4. That tells us that there's 4 times the amount of time in order to make this pricing relationship work. So that's what we're going to see coming into effect here. And to do that, and to see some of the misperceptions that traders have, let's jump over to an Excel spreadsheet. Okay, so now we're into an Excel spreadsheet. And let me explain some of these columns first. The first column shows the days to expiration. So these are just showing various days to expiration and the corresponding option prices. So here we have 5 days to expiration, 10, 15, and so on. And for all cases, we're looking at the $100 call. So that never changes. What does change is the stock's price. We're going to start with this column with the stock equaling 100, the current stock price, which is the at-the-money strike. And then we're going to look at times when the stock moves to 101, to 102, and 103. So here's the basic setup where I think traders make a lot of mistakes, and at least just not thinking through what they're stepping into. So for example, let's say that you are bullish on this stock and you want to buy a call. And the way that most traders do it is they say, okay, I'm willing to spend $2 because that's the most that I want to lose. So let's pick this one, trading for 209. And these are, by the way, all generated from a pricing model. So we've got 25 days until expiration. Now, of course, a lot of times they don't even say do I think the stock price rise is going to occur in 25 days? They base it on the option's price, just what they're willing to spend. But at any rate, for whatever reason, let's say that we've landed on this option for about $2. So next they'll say, well, the most I can lose is 2 or 209 to be technical, but I don't want to watch it completely evaporate. So if it ever gets down to, let's say, $1, I'm going to close it. So the first misperception that traders have is that if you paid for 25 days of time, because presumably you thought that this stock price rise was going to take place in 25 days, just because it didn't happen after 20 or 15 or 10 days remaining doesn't mean that you're wrong. And what you're doing is you're letting the price or your fear dictate when to get in and out. And that was never part of your premise. So again, let's just assume the trader says, well, I paid 2 and now it's at 93 cents, so I'm going to close it. Okay, so you were in this option from 25 days to expiration until 5 days, so for about 20 days. And notice in this that that is for a $1 loss. And again, this is how many people will set up their trading parameters. They'll say, well, I'm willing to take a $1 loss, so if it falls down to $1, I'm going to shut it down. But we could also buy lots of different expirations and still take a $1 loss. But what's that going to do for the time? See, we're just working this square root pricing relationship backwards. So to show you the math, what if we said we're willing to take a $1 loss? And that's watching the option bleed out from $2 down to 1. Well, I could also buy an option that is, let's say, around $3 and watch it go to 2. That would still be a $1 loss. But watch this. Let's say if we take 309, that would be paying $1 extra, and we divide it by the option that we're considering buying. That's a multiplier of 1.48. But because of the square root pricing rule, if we take the square of that, it comes up to be about 2.19. So this means we would be able to buy 2.19 times as much time. So let's do this times the 25 days, and that should be about 55 days till expiration. And look right down here at 55 days, just about $1 extra. We've gone from 209 to 310. Actually, they'd be a lot closer if we went out to 4 or more decimals. So we've added $1, and I could still say, well, let me exit this position if it falls to 209. That's still a $1 loss, but look what's happened. I can go from 55 days to 25 days. I'm in it for 30 days. See, before I went from 25 to 5, which was 20. So I've picked up another 10 days. So it might not sound like a lot, that's 50%. Well, if you were looking for a very fast, aggressive move inside of 20 days, you've now got another 10 days for that to happen. And let's just say that you're right. Maybe the stock does make a very fast move. So we're going to put the stock at 101, and this is assuming that it happens on the same day. Here's the stock at 102 on the same day and the stock at 103 on the same day. So if you paid 209 and the stock quickly rises to 101 later that day to 264, how much did you make? That's a 55-cent increase. That's basically your delta times the $1 change in the stock's price. Well, what would happen if we came down here to 310 and the stock went up $1? Now it's going to move from 310 to 364, which is 54 cents. So just about exactly the same move, which is always going to be true for your at-the-money options. But now here's where traders step into another myth, and they'll say, well, all right, but if I buy this option for 310, I might lose 310, and therefore if I just buy this one, I can only lose 2. And I just feel more comfortable having $2 at risk. Well, here's where this myth steps in. If you pay 2, that might be your maximum loss right now. But let's say that you're right and the stock goes up to 102 and is trading for 326 today. What's your maximum loss now? Now your maximum loss is 326. Because if you choose to hold it and it goes to 0, you've lost 326. You could close it right now. Well, what else could we do for 326? See, for 326, I could come down here for 60 days. That's going to give me about the same price of 323, and that's going to give me from 60 days to expiration to be correct. not 20 days. Now I've got 3 times the amount of time and virtually the same amount at risk, assuming the stock makes this fast, aggressive move that we're looking for. And what if it does make this fast, aggressive move? Well, it's gone from 209 to 326, which is a $1.17 increase. What if we had purchased this one? It goes from 323 to 436, and that's $1.13. So once again, about the same. We're talking about $1.13 versus $1.17. The reason the shorter dated ones becoming worth ever so slightly more is because of gamma. Your deltas are getting a little higher with fewer days to expiration, but they're virtually the same. But I've just got so much more time to be right. Now, what if we were willing to lose the full 209? Based on what we learned with the square root pricing rule, I could double this to 418. There should be an option priced at that level, and we look right down there. There it is. 100 days to expiration. No surprises there. It's exactly 4 times the amount of time. So I could buy the option for 417 and sell it for 209, which would still give me a 209 loss, but now it's giving me 75 days to be right. So once again, the real big misperception is that traders will look at this at 417 and they'll say, yeah, but it's basically twice as much as this one, and I don't want to lose that much. But if they really stepped back and thought about what they were expecting, a fast, aggressive move, I mean, look at this. If the stock goes to 103 in the same day, you're going to have $4 at risk, but you've only got 25 days to ride it out. Might as well be out here with 100 days. So these are just some of the things that you really have to think about before you buy a particular option. It's not only just about which strike, but it's also about which expiration. And what I really wanted to show here for our new traders is that it's not really all that easy to just say, let me buy the shortest dated one I can, because I will minimize my losses. There are other ways to minimize losses, but give yourself a better chance for success. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.